Hey, what's up everybody? And in this video, I want to recap what happened in Q1 2022 by taking a 10,000-foot view in the market. So you're probably wondering, what happened in the market? Why am I losing money, whether you're a long-term investor or a short-term trader? So it's important to take a step back and look at what happened in the last 3 months. So first of all, let me introduce you to this tool that is free and I really like. So this is called Finviz.com. So it's Finviz.com. And it has a lot of good information about the stock market. So today we're going to dive into one of the functions called maps. So if you look at here, there's the map where I can click on it. And this will bring you to kind of like a grid looking chart. Now, the other way to get there is go back to home, and on the right-hand side, you'll see there is that grid as well. So you can click on it, right? And that brings you to this map. Now, how do you use this? Obviously, if you look at the one-day change, that is too short-term, and you don't want to look at the market that closely. So what you want is to change this to a 3-month performance since we're analyzing the last quarter. So when you're investing in the market, it's important to not look at the market too closely because the market itself is very volatile. And just throwing in statistics out there, on average, S&P 500 will go plus or minus 20% within a year. So even though on average S&P 500 goes up by around 8 to 10% a year, in any given year, the volatility or the fluctuation for S&P 500 is plus or minus 20%. So if you look at one-day change and you get really excited about seeing green versus seeing red and not looking at the fundamentals of the company and the underlying fundamental of the chart, then it's going to be really volatile. And I know some people can't really take that volatility, which is why you need to focus on the big picture. So now we're looking at the 3-month changes for all of the major sectors. And basically the way you look at this map is the size of the square is the market cap, based on my understanding, right? The size represents the market cap. So then you can see, red means going down and green means going up. So you can see a lot of the semiconductor stocks like NVIDIA, Qualcomm, Intel, AMD, they're all going down. So then if you have stocks in these areas, well, the entire sector is going down. So it's not specific to NVIDIA or Micron technology or whatnot, but the entire sector is correcting. So when you're analyzing the stocks that you're buying, you also need to look at the sector as well. Now, when you look at the rest of the technology, then you can see like Microsoft, Oracle, Adobe, these like big blue chip companies are correcting as well. So you can see why the S&P 500 is not going up for Q1, which is why when you're investing, it's important to have that long-term mindset. So you can see other stocks like CRM, Intuit. So these ones are also going down. So basically, I would say majority of the technology sector has been going down since November. So if you have a unbalanced portfolio, meaning that your entire portfolio is focused on technology, then your portfolio would be getting a hit. Now, the next one, they have communication services, which I would consider that to be technology as well. And you can see that this consists of Facebook and Google, which is mainly going down as well. And then you have Disney recently going down because of a variety of issues like the Florida bill, so on and so forth, and Disney Plus subscribers. So basically, the communication services category is also going down. Now, if you look at some of the things that are going up, which would be healthcare, so ABBV, BMY, J&J. So I would say a lot of you wouldn't have exposure in these areas. So unless you are familiar with these healthcare companies like UNH or whatnot, then you probably wouldn't have any of it because I think most people have technology-based portfolio. Now, if you look at some consumer defensive like Walmart, Costco, and this continues to be going up because obviously inflation, higher food costs, and that can pass on to the customer. And basically, I think most people are cooking at home because restaurants are, getting pretty expensive. So that area is still going up. And some of the other areas that you may or may not have, depending on where you live, the first one is energy. So this one is a little bit more difficult. Not everyone will have oil and gas stocks. because usually they are more dividend focused stocks. But because oil price has been going up like crazy, then that's when you get an increase in oil and gas. But if you look at the oil price charts, then it actually hit a peak at around 120 something dollars. So now it's back down to $100 a barrel or even lower. So I think, yes, they are making more profit for now, but I think in the long term, it should be coming down since the oil and gas markets is cooling down in a bit from this point onward. So if you look at some of the videos I posted earlier, I also covered oil and gas before the 2021 winter. So for my oil and gas position, what I did within Investing Accelerator is that I first analyzed the supply and demand for oil and gas in September approximately. So that was actually one of the questions in Investing Accelerator during the weekly group coaching call, where we wanted to look at the European gas shortage. And that was actually before winter. And we come to the conclusion that we have an oil and gas shortage because Russia didn't have enough inventory and supply. A lot of the oil and gas countries, they're almost operating at capacity. And because we're stepping out of the COVID world, a lot of industrial manufacturing sites are ramping up and they need gas to run. So then that lead to a huge increase in gas, which people didn't prepare for. Like they didn't build up that inventory to serve this sudden rush in demand. So that leads to an imbalance of oil and gas. And if you are in UK or you know anyone in UK, there's actually an electricity outage. People are not getting gas because of that shortage. And historically, UK has really low oil and gas inventory as well. So that is actually what drove the oil and gas prices all the way to $120. So before winter, we were actually looking at a couple of oil and gas stocks, and my position was in Suncor Energy. So it's a Canadian oil and gas company, and we use options on it. So I think within the winter, almost to the springtime, I exited my oil and gas position and made approximately 100%. So continuing on, in the bottom right, you'll also see basic material as one of them. And then this is where you get like copper, gold related stocks or metal related companies like mining companies or junior mining companies. So that recently has been doing quite well. And that is really because of the supply chain shortages. And as we step into the post-COVID world, like a lot of industry, manufacturing are ramping up and they need basic material resources. And because of COVID and the wind down, they don't have enough capacity at the moment, or they're ramping up that capacity, which drives up the material metal prices. So you'll see a lot of markets have really high costs because of metal or gas or whatnot passing through downstream to the customers. So upstream is the mining site, passing it to the factory, passing it in the end to the consumer. So I'm sure a lot of you already feel that food cost is becoming more expensive, but wait till the metal prices start hitting the downstream markets, then we're going to see another wave of increase. When you're investing in basic metals, that requires in-depth knowledge because you need to look at the underlying prices. So let me show you what I mean. So this is a stock named Teck Resources. It is actually a Canadian mining company that I've been tracking from time to time. Previously, I made a few 100% here and there because of the commodity super cycle, but I actually didn't invest in Teck Resources from 2021 onwards. And here you can see that Teck went from 2020, $8 all the way till $44. And that is really because of the underlying commodity that they're based on, whether that's copper or zinc, that they're mining can be sold at a very high price. So when you're analyzing mining companies, unless you have that foresight or you are understanding that industry better than the average person, it's very hard to catch such a trend. So if you look at Teck Resources, let's say they're relying on copper, then you would look at copper prices. So let me just pull up the copper prices. And you can see that since 2020, copper prices actually went from $425 to $800. So that is almost 100% increase. And if you look at another commodity, zinc, which is something that Teck mines and produce and process, it also went from $180 all the way to $360. So that is 100% increase in terms of costs. If all the metal prices are increasing, that is going to lead to the factory having a higher cost, which then gets passed on to the smartphone makers, and then in the end you buy that smartphone with an increased metal price. So it might not reach us yet today, but then eventually it will be reaching us for sure. So if you are investing in metals, then I think you made a pretty good choice for the last quarter or so, so you should be in a good profit. So another trade we made in Investing Accelerator that is in the metal category is really around gold. So I think a year and a half ago, we analyzed the gold market and we thought to ourselves that Fed is printing a lot of money, so we think gold prices should be going up. So then we bought a position called Kirkland Gold. So you might have heard that I covered Kirkland previously on this channel as well. And basically during that time, it was cheap. And we bought it at a relatively good discount, but during that period, gold didn't go up immediately because it was missing a trigger. So then a lot of other stuff happened and gold prices basically stayed flat near $1,800 to $1,900. And when gold hit $2,000, $2,100 just maybe a month or two ago, then that's when the position generated around a 30-40% return. So then I decided to take profit after a year and a half and turn that into cash so I can invest that in something else. So that is another trade we made in Investing Accelerator. Coming back to the map, you'll also see that for the utility sector, it has been doing quite well as well. And I think that partly that's because of the energy crisis. So then there's more demand or higher price in terms of the utilities making a higher profit. So that is also makes sense. And then also I want to cover Berkshire Hathaway. So I think in the last 3 months, most of the market is either flat or down. And you can see Berkshire is up 10%. And I gotta say, over the years, I've been tracking a lot of different investors, whether that is Cathie Woods, that is very famous for investing in high-risk, loss-making companies, and Berkshire Hathaway. Here you can really see that even in a downward market, Berkshire really shines and is able to go up by 10% within that quarter. And historically, when people are basically commenting that Warren Buffett's strategy doesn't work anymore and we should invest in high growth stocks to make money fast, like Warren Buffett is not making money fast enough, that's not what Warren Buffett is about. Warren Buffett outperforms a lot of people during a downward market. And I think in the last quarter is the perfect example that Berkshire is performing well in a bear market. And if you think about it, in a high growth, liquidity, abundance market, people are willing to bet money on these loss-making company, which gets them ahead. But then when there's a bear market, that's when Warren Buffett catches up to you. And in the end, they make it even higher return than those high-risk investors. So I think if you do a comparison between Cathie Wood and Warren Buffett, they probably still have a positive return over the years. But Warren Buffett is quickly catching up and overcome that difference. And if you invested in Cathie's stock or fund during the peak of the tech bubble, then you would probably be down by quite a lot. Whereas if you put that money with Warren Buffett, even though it's not very sexy, it's not like fast, it's not like you're driving a race car, but Warren Buffett is more like a turtle, steady wins the race. So that's why when I reflect on the way I invest, you will find that within the free webinar, I always explain this, is that I focus on investing in discounted stocks. A lot of people might complain, oh, there aren't any discounted opportunities in the market, like everything I look at is always at a premium. Well, the truth is you need to learn how to find discounted stocks, which is the whole point of Warren Buffett's value investing approach. So I basically have a more value-driven approach instead of a growth approach, and combining that with options. So if you're interested in learning my strategy, then you can click on the first link below to see how I invest. I have a lot of examples in that free webinar, and the training is 2.5 hours long. So if you want to register for it, then it is in the description. So now you know this tool. It's free. It's actually pretty helpful. And when you're looking at the market, you can actually change it to look at the last 1 year, year to date. That's probably better. I could have used that one. then now we can see Apple and Microsoft are also down as well. And yeah, you got to remember a couple of things is that right now you're looking at the past. So then you're thinking about how you can perform better in the future, but it doesn't necessarily mean that the future will be the same as what you're seeing right now. And that's why you need to do analysis and work out what you think will happen in the future and where the opportunities will be. I'm going to use energy as an example. So obviously, there's a lot of tension in the market. Energy prices are really high at the moment, but once the war is resolved and the energy market cools down, then these companies wouldn't be making as much money. And if you try to jump into energy right now, I think one of the questions you want to ask yourself is, do you really see that the energy market will continue to go up? Is there anything else that is not reflected in the price and that you think is going to continue to drive up the price? And one of the things that we looked at in Investing Accelerator is really the amount of dividend that companies pay. So usually when people lose money per se when investing in the stock market is because the company pays a really high dividend. And this usually happens when they pay such a high dividend, like 6, 7, 8%, that is more than the growth of the company itself. So energy is actually in one of that category. So if you look at before the oil price crash and the oil price rally, like in regular oil price period, you'll find that these companies generally have a downtrend. So in Investing Accelerator, we only focus on companies with an uptrend, which I explain in the description below. And if you invest in a company with a downtrend and the company pays out a dividend that is more than the growth, then basically whatever gain you make on the dividend is in turn becoming a capital loss for you in the future, unless of course the dividend amount is more than the capital loss. So that is always something you need to consider. In Investing Accelerator, we avoid high dividend stocks, and we invested in the energy sector during that time because we knew that it was at a discount, and we know that there was a shortage, and all these factors added up together, which makes it a good play. But if you ask me again today, then energy sector, I think is pretty much done. Like we're 80, 90% there. There's probably like maybe 20, 10% room remaining. You need to consider the risk and reward, because what happens if the oil price suddenly goes against you? Then of course the energy companies will be dropping in price. And yeah, so it means that you should be planning to take profits, which means you shouldn't be investing in that sector at the moment. So here's what I think will happen in the next 6 months. So we already know that the market is volatile. And right now, we're almost near the end of April. We're going through the earnings seasons, and we see Netflix dropping 20-something percent. We see Twitter going up 20, 30% because of a buyout. And as we go through the rest of the earnings season, it's going to be volatile. And I know some of you will be emotional or might feel like giving up, especially if you're doing like swing trading, short-term trading, and you focus on like weekly or monthly results. It's going to be pretty devastating to see, for 3-4 months in a row, it's not making money. Like you feel like you're doing something wrong. And oftentimes it's because you're not looking at the big picture. And, if the entire market is going down, then you got to ask yourself, does your trading plan address a bear market? Maybe in a bear market, you just wait it out. Maybe in a bear market, you actually have strategies to hedge and make some money in the bear market while holding on to your long positions. So for example, in Investing Accelerator, we do have such technique to hedge certain positions when we think the chances of making money from when it drops is high. So we don't do that very often. We only do that in very specific situations. So in a bull market and a bear market, you need a solution for it. And if you have the solution that, hey, in the bear market, I'm just going to hold it out, then just make sure you're not too emotionally attached to the portfolio and you're not trying to check your gain and losses every 5 minutes, because that's not going to help you. And what I find over the years is that the more frequent you check your portfolio, which is usually when you're down, the more likely you will make a bad decision. And this really comes down to emotional trading, emotional investing, is that imagine yourself looking at the market once a month, which is 12 times a year, and you take an action at the end of the year. So that is one decision in 12 months or 12 times. Now, if you check the market like 10 times a day, so in 2 weeks, you'll be checking the market 100 times. So that means if you want to be patient, a long-term investor, it means checking the market and not making a decision needs to be like less than 1% of the time. So like if you make one decision out of 100 times you check the market. So that is something you need to consider. And usually what I find is the more you check the markets, the more stressed you are, and you end up making a bad decision, like exiting at the lowest low, and then suddenly the market goes against you and going back up, and now you're chasing because you think you're missing out. So yeah, make sure you try to not make bad decisions. And stock investing is pretty easy per se if you look at it long term. And if you're really concerned, then just put the money in the S&P 500 so then you make sure you don't miss out. Because I'm doing a lot of analysis and I think we're near a turning point. And I think later half of the year, we should be fairly positive in this market, even though right now it seems like everything is doom and gloom. So that's it for this video. And if you like this video, then give me a like and watch more of my videos. That would really help the YouTube algorithm and promote my videos to other people as well. So I'll see you in the next one.